Let me shift into something that I caught in one of your presentations, talking about the efficient markets hypothesis. Mm-hmm. And this is from your presentation. This normal statistics suggest that a one-day price move outside of plus or minus 5% in the Dow would occur once every 26.4 years. It's actually happened 129 times in the last 80 years. And you go on to make the point that this phenomena has been prevalent in all freely traded markets on all time frames. Why don't you discuss that? That really gets at the root of perhaps one of the great sources of where your return is coming from, is that so much of the world actually still believes, regardless of how many Nobel Prizes are handed out, still believes in the idea of efficient markets, and that you, Scott, can't do what you do, regardless of that performance number that I read at the beginning of this podcast. That's all an illusion. It doesn't really exist.
Well, that goes back to why people hate trend following, right? The efficient market that they learned about, and they spent $200,000 on a business school, and they learned these things, and guys won Nobel Prizes from them, smart guys. But basically, the distribution of market returns is non-normal. It has a peak well above the bell curve, and more importantly, it has tails that are extraordinarily fat. Now, that isn't to say that they're frequent, but like you said, and I missed all the, specific, but, things that are supposed to happen once every 1,000 years happen about once every 50 years. The spread is even greater than that. And so if one of the things I have long thought is, I think a lot of, if not all of, the edge in trend following, if you think about a fat tail, and what that means is there's a large 3+ standard deviation from the mean move. And particularly if you couple it with the high peak, meaning that there are more moves within half a deviation than there should be as well. Think about a trend follower getting in a market and putting a stop somewhere outside that high peak and profiting from these 5 deviation moves. That's probably going to be the basis of a profitable method.